What about the fact that the government occupation in the private sector will prevent growth? To a certain extent, I agree with that over the long term. Okay, but that's not what we're talking about here. We're talking about the immediate term. And so to put in perspective how active your government has been over the last year and a half, during the Great Depression, we shed 27 percentage points of GDP. The economy shrunk by a third. The government's response, 8% of GDP. This last event, the Great Recession, the economy shrank by 4%. The government's response, 30% of GDP. They have purchased a lot of GDP. And so in the short run, I would argue and say that right now, the fix is in. So if the new normal is not normal, what is normal? Now, how many of you recognize Victor Zarnowitz, right? Yeah, so he doesn't get a lot of press, but he was a great economist, and he came up with something very profound. His economic contribution was, I think the deeper the recession, the more robust the recovery. That was Victor's great contribution to economics. And if you look at this chart, what you can see is post-recession growth on the left-hand side and maximum quarterly contraction in a recession on the bottom. And so the deeper the recession, the more robust the recovery. That is the normal. And so at the darkest moment in the first quarter of 2009, we shed more than 6% in GDP. And if history is a guide, then we should gain somewhere to 8 to 10% going forward. That is the normal. Now, you see a lot of people on TV who want to talk about the growth alphabet, right? This is going to be an L recovery, L-shaped. We're just going to fall off a cliff, and then we're going to bump along the bottom forever. And then you've got those who say this is a U-shaped recovery. We're going to fall off a cliff, we're going to bump along the bottom, and at some point we're going to go up again. And then you have those like Victor who would tell you that this is going to be a V-shaped recovery. Well, I'll let you be the judge. This is the path of U.S. GDP going back to the early 80s, and anybody see a V? It's a V-shaped recovery. Thank you, Victor. All right, so one more slide for Victor, and then we'll move on. But so let's go back and pick on the IMF again, okay? Although, this will keep me from ever getting a job there if W&A doesn't work out. So we are taping this. So going back to the IMF estimates, if you looked at the October IMF estimate for global GDP, you will find their expectation for 2010 is that the globe would grow by 3%, that the advanced economies would grow 1.5 or so, 1.3, and the developing economies, of course, would do all the heavy lifting and they would grow by 5%. 2 months later, they revised their forecast. So now they think the world's going to grow by 4%, that the advanced economies are going to grow 2% plus, and that the developing economies will grow 6%, and of course China will lead the way up 10% or so. And so again, the rule is don't put too much faith in pessimistic economists. Take them with a grain of salt. Okay, so let's talk a little bit about unemployment. The headline unemployment rate is the quintessential lagging indicator. And so yes, 10% unemployment is painful, but it doesn't give us a picture of where things are going. The line that I just brought up was the initial unemployment claims, and as you can see, there's improvement there. That doesn't mean there's job creation really yet, except for some government fidgeting with the numbers. And we got a kind of a weak number, say Thursday, this morning. But things are improving on the employment front. It will probably take us about 5 years at least to get back to full employment. So once we start adding jobs, I expect we can add them at a pace of about 1% a year. Okay, let's talk a little bit about inflation. And let's go back and think in our textbooks, turn to page, and talk about Milton Friedman's, right? His theory was the quantity theory of money. Basically, that all things being equal, the more money you print, the more inflation you have. And so let's dissect his equation, MV equals PQ, and turn it into a story. So as you can see, as we got into the end of 2008, as you know, quantity of demand, quantity of supply, GDP fell off a cliff. And that took consumer prices down with it. There you go. So what did Ben Bernanke do? He's the foremost student of the Great Depression, and so what he knows is that deflation is a far worse enemy than inflation, and so he dramatically increased the money supply, started running the printing press. And that was the right thing to do. But now they're kind of caught in a box canyon, as a friend of mine would say, because right now what we're seeing is a recovery in velocity, right? And velocity is how quickly we move money around, how quickly we transact, and really it's a confidence barometer. So confidence is not surging yet, but it is recovering. And as that confidence recovers, what it'll demonstrate is inflationary pressures. And so this is that same CPI chart, and what you can see is growth there. And so what are they going to do about it? Well, the marketplace is telling them that they need to tighten. Okay, and this is the difference between the 10-year Treasury yield now and about a year ago, and the difference between the 2-year yield and the 10-year yield, which is basically the market signaling to the Fed, there's going to be growth, there's going to be inflation, you need to acknowledge it. So how's the Fed going to acknowledge it? Well, they've got two ways to do it. One, they can reverse their quantitative easing programs. What does that mean? Well, they had a $900 billion balance sheet. Now they got a $2.2 trillion balance sheet. And the way they grew it was they bought $1 trillion worth of mortgages and $300 billion or so worth of treasuries. And so if they want to shrink the money supply, all they got to do is sell those back into the marketplace and absorb all that cash. And so that won't be as obvious as the change in the discount rate or the change in the Fed funds rate, but it's a program that has begun reversing, and so that's one way for them to remove monetary accommodation. The other way to do it is the obvious way. This is the Fed funds target rate going back to 74 or so. As you can see, we're on 0. Know that every time Bernanke says extended period, which he said yesterday, somehow that's code for we're not going to raise for 6 months. So he said it yesterday, we got another 6 months in the sun, which is good. So why are they keeping rates low? To inflate asset prices. What business are we in? We're in the asset management business. That's a good thing. Okay, so what does that mean for the dollar? Well, we've got a couple of dollar positives here. And currency movements matter a lot more than they used to. The Japanese and people around the globe always paid attention to currency. Americans never did because everything's priced in dollars. Well, now we're a little bit more sensitive to currency and it's more demonstrative within the markets. Well, right now we expect that the dollar stabilizes or rises for the following reasons. One, the Fed tightening is a good thing. Two, you all are now familiar with the PIGS acronym, right? Portugal, Italy, Ireland, Greece, and Spain. These are countries in Europe that have pretty ugly balance sheets. And so that's put pressure on the euro, which makes the dollar look more attractive. And the Japanese economy knows that it lives and dies by exports, and so they have an incentive to lower the cost of their goods and services, which they do through basically devaluing their currency. And so that'll be good for the dollar as well. And we do have a growth advantage in the U.S. right now, and once dollar movements start heading a direction, they tend to kind of go that way for quite a while. So our outlook for the dollar is positive. What does this mean? Can we make any money? Good question.